Tom Lee, an incredibly successful financial analyst, just went on CNBC recently and made some very bold calls about the broad market here. So we're going to be covering everything that Tom Lee has said to give you guys a better understanding of what to expect next in the market, while also providing a little bit more context to the market right now by going over things that, quite honestly, nobody is talking about, but are honestly the most important things that are driving the price action in the United States stock market right now. A lot of people are talking about tariffs. They're talking about this new administration coming in, but there are a couple of other things that are happening behind the scenes that you guys absolutely have to be aware of. So guys, before we get into all of that information, if you guys do enjoy the information and analysis that I provide for you guys in these videos here, make sure you go down and hit that like button. It costs you nothing to do it, but it helps me out a whole lot, spreading these videos out to as many people who actually want to learn. And again, if you want to see more videos like this, make sure you hit that subscribe button and turn on notifications so you never miss another one. So without further ado, let's play this first Tom Lee clip before we start breaking down everything that we need to.
I don't think an obvious or a logical conclusion to have right now with all the bad news that we're hearing about these policies. Everybody thinks the market's headed lower.
Yes, but instead we could be bottoming, maybe this week.
Now, as you guys heard from that clip, it's pretty apparent that Tom Lee's short-term view is that the markets are reaching somewhat of a short-term bottom. And as we look into his most recent article here, it also is possible that we're moving into a period of the 10 best days of the year, which are very, very important to be a part of. When we take a look at this article here, a 10 best days probably coming this week. Since 1928, missing the 10 best days in a year cuts returns from 8% annually to negative 13%. We are seeing signs of investor panic, and while many want to exit the market, the rule of best 10 days strongly argues against market timing. And what he's referencing here is a lot of investors looking to sell the lows, thinking that this market is going to continue aggressively to the downside and potentially getting better prices on the equities that they want to purchase. Now, again, they need to worry about any of those short-term or long-term capital gains to make sure they would be getting better prices in kind of addition to those taxes that they would have to pay, hopefully, if they were green on some of their positions. But again, we are seeing a decent amount of that panic in the market. And again, as we move down a little bit further, in other words, markets are so oversold and pessimism so high that a sizable rally is near. Well, when we take a look at the market from a technical perspective here, what have we seen? We've seen, again, as this trade war and all of these new developments with tariffs picking to the upside, we've just knifed through all of these prior all-time high zones like butter. We retested this prior one and then moved it down and just kissed this 200 exponential moving average on the daily time frame, along with volume really starting to pick up at these lows here, which could potentially be a sign of a bottom. Now, I also want to briefly talk about with you guys the seasonal nature of markets, and this is kind of one of the things that people aren't really talking about right now, but it's not the most important thing. When I throw up this screenshot right here to all of you guys, again, you look at Q1, it's a little bit choppy, but as you zoom in and kind of take a little bit of a deeper look at what happens in the beginning of March, typically, you see a little bit of a dip. The second week of March, kind of the first to second week of March, we bottom and we start making that aggressive move to the upside there. Now, for me personally, looking at the markets from a seasonal perspective really isn't the most important thing in my view, because the way I look at it, every single year is different. Every month, all the macro data is always different. All the different earnings expectations and results are different. But having that understanding of, okay, these are data points that large institutional investors are looking at right now is something that we always have to keep in mind, even if it's not something that we're going to be making big investment decisions based on. Now, in addition to this, we also have non-farm payroll data coming out tomorrow, which is going to be a huge event for the markets, especially as we are starting to see some of the effects of a lot of these job cuts in the government. Now, if we end up seeing a significant miss on NFP to the downside and the unemployment rate starts to move to the upside, again, a significant miss, the markets are not going to like that and will probably sell off pretty significantly. But If you are to see kind of a little bit softer, unemployment ticks up a little bit, but it is still missing to the downside, just not as aggressively. What the market is most likely going to do is view this as, oh, this could then step up the expectations for more rate cuts coming sooner. And one of the most important things that I want you guys to pay attention to on this chart here is when we got our last rate cut, which was Wednesday, December 18th. If you guys remember this day in the market, we had what was deemed to be the hawkish cut. The Fed cut rates by 25 basis points, kind of looked at the data and said, we don't really feel the need to cut interest rates by any more right now. We're going to be very data dependent going forward, and that caused a decent sell-off in the market going into the end of the year. We had a nice rally back to the highs, chopped around, and then the new tariff fears came in. So what this market is really waiting for is the Federal Reserve to start leaning more on the dovish side, because right now they've been pretty neutral or a little bit leaning on the hawkish side. And when we take a look at some of these rate cut expectations, again, non-farm payrolls tomorrow are going to be very, very important for driving this price action and these rate cut expectations, and you're going to see it in the bond market as well. When you take a look at some of these expectations here versus from what they were a week ago or even a month ago, we were pricing in for 2025 a 6.1% probability for 100 basis points or 1% of rate cuts from the Federal Reserve in the year 2025. That projection now is at 21%. And that's obviously been reflected in the bond market, seeing interest rates move to the downside there. And you can see it kind of stepping up across the board, where about a month ago, the expectation for about 3 rate cuts was 18.4%. Now it's sitting at about 32.2%. And that is now kind of the median expectation for what the Federal Reserve is going to do in 2025. But again, we haven't necessarily seen any of that guidance from the Federal Reserve yet, confirming that that is what they are looking to do. Obviously, with the way the new administration is running things right now, that is a risk that unemployment starts to head to the upside, GDP starts to move a little bit lower, and then some of those effects could counteract any price increases that you're going to see in certain pockets of the market, because the demand for those goods and services will not be there. So these companies won't be able to charge these higher prices because people will not be able to afford them. Or if you guys are paying attention to that statement, little bit of a stagflation risk right there. But what we're going to talk about now, guys, is something that nobody's really been talking about in the market, and I think is incredibly important. And again, we've talked about this in the private group and on Twitter and on the public streams that I do. But this is something that not a lot of people have seen, but it's so important to understanding the flows of money in the market and getting a better understanding of the big picture. Because if you want to fully have or have like professional level results in the market, you have to understand the big picture. Okay, the first thing that I'm going to show you guys here is the year-to-date performance of the Chinese large cap ETF. It's up about 21.5%. Then we look at the DAX, the German markets here, and this is up about 17%. Then we can take a look at some of the European markets here. And these are up about what? Let's throw this on the 12-month time frame here. These are up about 5-6% right now. You look at the S&P, and you throw this and see what is happening year to date. We're down about 2.3% here. So what does this tell us? Foreign markets are outperforming U.S. markets. And when a lot of people are looking at this chart here of the dollar right now, they are looking at this move down recently that we've seen in the dollar and are saying, oh, this is going to be really good for risk assets. Well, we've seen the dollar move from the highs of 110 to the lows of today, I believe right around 104, 103.80. And this has done absolutely nothing for risk assets. And understanding the context of these moves, guys, is the most important thing, because the dollar could keep moving to the downside here, but that does not mean at all risk assets are going to be moving to the upside. Now, if Tom Lee is correct in his expectation that, okay, the market could start moving back to the upside here, yeah, some of these small caps, Bitcoin could end up moving back to the upside here, but it's really not correlated to this move in the dollar. What are we seeing? We're seeing money move out of US denominated assets and into foreign markets. We're also seeing this reflected in the chart of the Japanese yen versus the dollar. when we take a look at USD JPY here and look at what this has done over, let's say, the last couple of weeks here, this has moved very, very significantly to the downside from the highs of the upper 150s, 158, 159, all the way down to 148. When this happens, a lot of those large investors that were participating in the carry trade, where they were taking out loans of Japanese yen, they are converting it to dollars, and they are buying US assets, effectively shorting the yen and longing the dollar, and then buying assets denominated in dollars. This move that you see here is going to force some of them to repatriate. So don't let that big word confuse you at all. All they're doing is taking their US assets, selling them, converting those new dollars that they have back into yen. But all that's really doing is showing us that that's just another pocket of the market where money is leaving US markets. Now, that money is probably going to come back at some point, but the market needs to see something out of US markets in order for it to feel more comfortable coming back into the US. Maybe that's the trade war getting resolved. Maybe that's the Federal Reserve being a little bit more dovish and saying, okay, we're looking, and kind of our expectation is to cut interest rates a little bit more this year than we previously thought. Either way, the market needs to see something in order for a lot of this money that has left US markets to start coming back in. Now, China is a really good example of this here, guys, where obviously you guys know that my long China thesis played out pretty well over the last year. But now you wouldn't necessarily be going long Chinese stocks based on new stimulus coming in. What you're really looking for is the shift from everybody viewing China as uninvestable to a really good opportunity. The reason for this is, again, you saw a lot of these really large American AI companies. Everybody was throwing money at them. In 2024, you saw Nvidia run, AMD, a lot of these semiconductors, Palantir, a lot of these other companies got a lot of attention from the market. Now this year, and kind of at the end of last year, what are you starting to see? Well, Chinese companies are starting to develop and release either comparable or in some cases slightly better products of their own. Now, for these investors that were interested in buying these American companies at some significant multiples, if you could buy something pretty similar in China at a significant discount, why wouldn't you put some capital into that? So that's just another way to view this, guys, of the flow of money in the markets. And again, we'll see. Tom Lee could be correct in his assumption that markets could be bottoming this week. He has seasonality on his side. We're just kissing the 200-day moving average on the indexes. And we do have a really large report coming out tomorrow in non-farm payrolls, which definitely could cause a little bit more volatility in the markets, but could let them move to the upside there. But guys, that is going to wrap up this video here. I know I threw a lot of information at you guys. If you did enjoy the information and analysis I provided for you guys in this one, make sure you go down and hit that like button. It costs you nothing to do it, but it helps me out a whole lot, spreading this information out to as many people who actually want to learn. If you guys do want to see more videos like this, make sure you hit that subscribe button and turn on notifications so you never miss another video like this. But until then, guys, I'll see you in the next one. Peace.